I think Professor Meatball is telling us that there's a lot of green in our future. My name is Andrew. I'm here in my tiny little apartment garden box, but it is growing green for the day. Both of our stocks running nearly double percentage points, GME especially, and I want to tell you guys why we are the most shorted we've ever been, why this is exactly the same as the June gamma squeeze, and 4 big things the SEC is considering doing. The only way you can get all that information is by slapping that like button right now, all the way up to 1,300. Comment out which one you are in the comments, and making sure that you guys watch until the end of the video. Those are 2 important details to be able to get the most out of this financial education. So first of all, I want to tell you guys, welcome to my little apartment complex garden here. I have the data right here in my hands, and I have to tell you guys about payment for order flow. Because right now, because of the AMC and GME craze in 2021, SEC Chair Gary Gensler is now considering taking it all away. So what exactly is payment for order flow? Why exactly might it be going away thanks to Chair Gary Gensler? I have the data in my phone right here. It is, under the current market rules, brokers like Robinhood and Charles Schwab are required to perform reasonable diligence. And what does that mean? It determines the best way to route a so-called market order in which a retail trader does not specify a minimum or maximum price for a trade. It's when you press that buy button, right? Just like you guys already smashed that like button. So the process is called payment for order flow, or PFOF, PFOF. If you guys like acronyms. Robinhood and other brokers receive compensation for routing their orders to specific wholesalers, like Citadel and Virtu. Those are the 2 biggest ones out there. We've already taken a look at exactly how much volume flows through the data. If you guys haven't seen that video, make sure that you guys do subscribe to the channel and hit that alert button. So, off-exchange market makers make payments to retail brokers for the privilege of having their customers' orders routed to them first. The market maker will execute directly against the retail order if they think that they make money from it. They are basically paying for the privilege of having first dibs to trade against the dumb money. And this is not just small peanuts. This is 70% of Robinhood's 2021 revenue came directly from payment for order flow. And now that might be going away, is this the end of the modern age of retail trading? Or is it just the beginning? Because first of all, payment for order flow allows the big market makers to essentially bet directly against you, the small trader. And when that happens, you basically have no recourse. It's like saying my house, the same house that guy's selling across the street, is worth $100. And you advertise directly to that guy while he's trying to sell the exact same house. And no one else knows about it. He can just directly undercut you milliseconds before your house hits the market for everyone else. Therefore, both of you guys end up essentially having antagonistic positions. And guess who's gonna lose? The smaller player. So that is what Gary Gensler is fighting against, making sure that there is no payment for order flow in the near future. But that is only one of the 4 major things that Gary Gensler is considering right now. So we have seen him try and be helpful to the apes, but we've more recently seen that he has essentially hurt the apes big time. I'll put a clip of that right here next to my face.
Welcome back, Brad. It's your investment.
I'll take meme stocks. Invest!
I have no idea if that was the right timing, but I really do hope so. Essentially, Gary Gensler is saying that there is going to be ridiculous changes in the near future. Essentially, what Gary Gensler is saying here is that meme investors don't do enough research. But you know that is not the case. We have done plenty of research. In fact, I have it here on my phone. Here are the top 4 things the SEC is considering doing especially because of the AMC and GME craze. Number 1, they explored the proposal to allow stock exchanges to quote shares in less than 0.01 cent increments. So that is already something to be able to level the playing field with larger market makers, right? Larger traders who are able to essentially quote prices that the retail investors cannot access. The SEC weighed creating a more rigid version of the so-called BEX execution rule that directs brokers to find the most favorable terms for their customers. This is what we were talking about with payment for order flow, and that is a reminder that the SEC is trying to establish brand new precedents for the stock market. Number 3, they also aimed to reduce the maximum fee that exchanges can charge brokers to access their quotes. This one's pretty important, right? Make sure that you understand that the very top of the green graph is a little rose. And at the end of the day, that maximum fee that exchanges can charge brokers will end up affecting retail investors as well. And finally, SEC Chair Gary Gensler directed the staff to figure out ways to make the stock market more efficient for small investors and public companies. This is a popular idea emerging that require brokerages to send most individual investors' orders for routing into auctions where trading firms compete to execute them. So the SEC staffers began floating ideas with market participants in recent weeks, and Gensler looks to detail some of the potential changes on June 8th. Okay, so the most significant change under discussion would affect the mode of handling trades after an investor places a so-called market order with a broker to buy or sell a stock. Gensler is looking to ensure that brokers execute orders at the best possible price for investors. The auctions under the SEC consideration will help different firms compete to fill an individual investor's trade. So now that you guys have a better understanding of what the SEC is going to do, I am going to make sure that you guys understand the charts today as well. Because last June, we exited onto a critical level of support. We had the price action hit $12. If that sounds familiar, that is exactly when the dip below 12 rocketed AMC to over $77. And this is the same same exact time frame as when we saw that price action. So now that we're looking at a brand new year, are we essentially looking at deja vu part 2? So what we want to be able to understand is whether or not the short interest and the FTDs are having the exact same patterns. And it seems like right now, we're at an all-time high in terms of short interest. Ortex is explaining exactly how the market is getting scraped and how we're finding out the short interest ahead of the rest of them. So we have that Ortex data on stage right here. If you guys have taken a look already, it means that these are larger numbers than we had ever seen this year. So now that we are paying attention to that short interest, we know that AMC and GME especially are in very specifically pattern-wise deja vu settings. It is the same thing again, and I cannot wait to see exactly where that price action goes. So if you guys enjoyed the education in this video and you guys want to find out a little bit more about how to get that six-figure portfolio, how to be part of the Moon Platoon, and how to give Professor Meatball a treat right down here sitting in the shade, then make sure that you guys have already slapped that like button, hit that subscribe and that join button if you guys are so inclined, and make sure to check out that second channel where I discuss more about the musical pursuits of my data goals. For now, but not for forever, I'll see you guys in the money.